Ready?
Okay,
Action. Both feet are in bounds. Let's go.
Good morning, everyone. Welcome to the investment meeting for February 2012. With that, let me turn it over to the chair.
Yeah, good morning. Let's go around. Andy Schaefer representing Commissioner Kelly.
Barry Dennis, SAS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Ganley, SDA.
Kenny Sparks, DEA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Martin Gans, Controller's Office.
Thad T, Controller's Office.
Larry Schloss, Controller's Office.
Janice Emery, Finance, and also I have the proxy for the mayor today.
Bob Sanskistad, Pension Fund.
Kevin Holloran, Police Pension Fund.
Leon Johnson, Controller's Office.
Neil Messing, Controller's Office.
Okay, with that, let me turn it over to the Controller's Office. Larry?
Thank you.
Hold on.
And then I'm holding the proxy for the CEA as well.
Okay.
All right, and we also have, speaking of proxies, for Pat Lynch, for PBA, Joe Alejandro, for John Puglisi, Dan Torelli, for Joe Strong, Joe Alejandro, and for Mubarak Abdul-Jabbar, Joe Alejandro. Thank you. And with that,
That's me? Okay, thanks. Rather than go through the economic indicators, we have Citibank in here today with their economist, Bill Lee, but I'll let them introduce themselves. I'll have Tim Sheridan introduce Citigroup. Do whatever you like.
why don't you sit next to him?
Over there.
Yeah.
Are they Boston fans?
Hold on one second.
Not today, not anymore.
Today, you're not spaceman, Bill Lee.
I was born on the Lower East Side.
All right.
Don't tell me you're a Jet fan.
Certainly not today.
So thank you, everybody. We appreciate the opportunity to present a brief overview of some developments in the global economy. As was mentioned before, Bill Lee is our economist. He's a managing director in the Office of the Chief Economist. Bill has spent 18 years with the IMF, and prior to that, tenure with the Federal Reserve. And with that said, I'll turn it over to Bill.
Thank you, Tim, and thank you very much for inviting us here. I'm very honored to talk to you about our outlook on the global economy. I want you all to know that I'm a newbie at Citi. I've spent my entire professional life with finance ministers, central bankers, and at the IMF and at the Federal Reserve. So the picture I'm giving you is a global perspective because I believe a global perspective is really important in this day and age when there are so many regional developments and things going on in the emerging markets, in Asia, in Europe. And I'm glad to find that my Citi colleagues also share that global perspective because that's what you need these days to keep things in their proper perspective. The media has taken hold of Europe, and everyone is following what's going on with the Greek negotiations and the euro area on a blow-by-blow basis. So I'm going to touch on that, but I'm not going to focus on that because I think what's important for you is what's also important for us at Citi. It's identifying growth opportunities. And we at Citi believe that these growth opportunities are associated with areas that have certain preconditions in place for that growth so that growth can be sustained. You don't want to go into an area, invest in an area, and find growth stuttering out and find that you're going to have to reverse your decision a few years down the road, especially you with an investment horizon as long as you have. So let me start off the discussion by also noting that we at Citi have a particular way of viewing the global economy, and if we start on page 3 of your handout, you'll see that we think the global economy rolls on two tracks. The emerging markets are on the express track, and it's the advanced economies that are lagging behind. The developments in Asia, in Europe for the last 6 months or so have caused a lot of us to become much more pessimistic, and we at Citi have also turned more cautious. And if you see on page 4, we have taken down our forecast for the global economy considerably. We've downgraded the advanced economies and the emerging market economies by a considerable amount. So that on page 5, what you see is that we're now projecting the global economy to grow at about 2.25%. What that means is that we're still skirting above a recession. And on a global scale, a recession means less than 2% growth. We think that with Greece and Portugal doing what they're doing, the euro area is in a recession as we speak, and they'll stay in a recession well into next year. I also point out on chart 5, the emerging market economies are slowing down, but they're still the main engines of growth. China, we think, is going to come out of its soft landing. It'll grow somewhere on the order of about 8.5% this year, just below. But what's amazing about China, and something that you should be very aware of and be cognizant about, is that China is transforming itself. We think that over the next 5 years or so, China will in fact settle down to a much more sustainable pace of growth, something on the order of 7.5%, much lower than the numbers that we've talked about. And why is that? Because China right now is transforming itself from a low-cost production center, an export-oriented economy, to being one that's more focused on income distribution, raising consumption, doing more for its people, because the concerns about social unrest are certainly in the minds of all of the government officials. What's going on in the Middle East and throughout the world hasn't escaped their attention. And so the next 5-year plan calls for developing domestic industries, calls for developing strategic sectors. Healthcare and clean technology are the two most prominent ones. But China itself is transforming. China, 10 years from now, will not be the low-cost production entrepot, the trade entrepot that it is today. So with that message about the global economy slowing down, it's pretty clear, you'll see on the next page, on page 6, that all of these drags on the global economy mean that we're going to expect interest rates to be low for some time to come. We're expecting the ECB to cut interest rates by another 0.5 percentage point sometime this year, probably around the middle of this year. And we're anticipating that real interest rates, all through the advanced economies, will be negative for some time to come. Here in the United States, it's pretty obvious that with the Federal Reserve transparency that's been put in place, which is a remarkably different Federal Reserve than when I was there, because during the days of the Federal Reserve when I was there, the whole issue of communication was mind-boggling. Communication meant Paul Volcker would take his stogie out and blow smoke in your face. That's communication in the mindset of a lot of Federal Reserve officials. But now, with the benefits of transparency, what we know is that the FOMC will not be raising rates until well into 2014, and maybe even beyond that, unless the economy starts to pick up. So why is there a drag on the global economy? I think the answer is shown on page 7. Leverage. We've had so much leverage built up in the private and public sectors that the deleveraging that's going on now is going to be protracted. It'll take some time to unwind itself. On the next page, page 8, what you see is that public sector indebtedness is pretty intense. And what do we mean by intense? How do we gauge leverage? How do we gauge being excessively over-leveraged? On the public sector, let's remember what criteria we used to use. Remember Maastricht? That was the criteria that was supposed to be 3% fiscal deficits as a share of GDP, 60% debt to GDP ratio. That was what was needed to ensure that members of the euro area would be able to converge and sustain a fixed exchange rate among all of its members. If you take a look at that chart, especially on the left-hand panel, there's no EU country that satisfies Maastricht today. If you look at the right panel, there's hardly anybody in the world that satisfies Maastricht today. Probably China is somewhere near Maastricht. So we have a situation where the public sector is incredibly leveraged. On the next chart, page 9, you'll see that despite all the slowdown that I've been talking about, the private sector has actually done a pretty good job in trying to restructure and rebuild its balance sheets. We know that the large corporates around the world have been flush with cash, and they've been doing a very good job trying to build down to restructure its balance sheets and to deleverage. But as a consequence of all this high leverage, you'll see on the next page, is that from a macroeconomy perspective, the recovery that we're experiencing today is very different from the kind of recovery that we would typically expect. Whenever there's a shock to GDP and we enter some sort of recession, the burst of growth coming out would normally exceed trend growth. potential GDP growth. Somewhere on the order of 2.5–3% is potential. So we expect GDP to grow 3, 4, 5% a year and get us back on track to where we were prior to the recession. If you look at the right-hand panel on page 10, you'll see that we, in fact, are suffering through a prolonged, protracted period of muddling through. Very slow growth. We're coming back to potential, but that means that we've never exceeded potential. We've never gotten back on track to where we were, where we would have been. And if you look at the next page, on page 11, I compare our recovery to that of other, the EU, the UK, and also as a benchmark, let's take a look at Japan. By that benchmark, we may be doing all right. I mean, it's not much of a benchmark because remember, Japan was suffering through the lost decade, right? So let's expect from here, for as far as the medium-term eye can see, we are going to be going through a muddling through a period of slow growth. So that's the mindset I hope you'll take into all of your decisions. I guess I have to talk about the euro area to some extent. The latest blow-by-blow, I won't trouble you with. Greece is in the headlines. Greece has been a little epicenter of what's going on in the euro area. The big question now is, will Greece be able to put together the reforms in a credible way to meet the requirements of the Troika package? Will they, in fact, be able to collect enough tax revenues, reduce expenditures to live within their means? Greece is a tiny little economy, 2.25% of euro area GDP. It's punching way beyond its weight in terms of market disruption. I show you some of these numbers on page 13, just for comparison purposes. And on page 14, you show I show who it is that owns all of their debt. As I said, a debt to GDP ratio of 140% of GDP, and a rapidly declining GDP at that. Again, I don't want to dwell too much unless you have some questions, which I'll answer gladly later. But the key structural issue is, will they be able to get their act together in order to come back into the marketplace? And what do we mean by marketplace? Will they be able to credibly issue sovereign debt in a way that you guys would want to buy it? And a lot of the schemes that are being put in place is to enhance the value and attractiveness of that sovereign debt. Now, I know that you have an opportunistic fixed income investment strategy that you're sort of growing. And so these are important questions for you to consider. Is it worth buying these kind of assets? I'm not a market strategist. I'm an economist. And as I said, I've been dealing with policy wonks, central bankers, finance ministers my entire professional life. So let me focus on that part of the spectrum. What these guys have come up with, and these are my former colleagues at the IMF and in the finance ministries, is a way to enhance the value of the fixed income assets, either through a co-insurance scheme or a co-investment scheme. And it all comes under the rubric of EFSF, the Euro Area, European Financial Stability Facility. And later on this year, we're going to hear about the ESM, right, the Stability Mechanism, which is a big credit union, right? Everybody dumps money in and they can borrow money out. The whole point of this stuff is to enhance the attractiveness of these assets. Well, you've got to ask yourself, does that address the fundamental problems? Let's get back to Greece. Will they have a credible program in place that will raise their fiscal situation and restore their fiscal situation to a sustainable, credible position? That's the question you've got to answer. And that's what the marketplace is struggling with. And that's the heart of the negotiations that Lucas Papademos is going through right now. Lucas, by the way, I don't know if you guys know, but he used to be a professor at Columbia. He used to be on my advisory board. And Lucas is as straight a shooter as you're ever going to find. He is an honest technocrat, MIT trained, and really among the best of the economists. So he actually knows the technical stuff of what's going on. What is difficult is dealing with the politics, and that I'll leave aside for a moment. Let me talk about a more fundamental issue, because the other issue that people ask about would be, what about the euro area? Is it sustainable? The likelihood of Greece exiting the euro area has become something that was unthinkable not so long ago to something that is not unlikely. In fact, I think we as Citi are betting something like 50-50. The issue is what kind of withdrawal. So let me back up a moment and ask the question, why is it that the euro area is suffering through these issues? let's go back to Maastricht. Remember, the euro area is nothing more than a fixed exchange rate system. It's a fixed exchange rate system where countries are tied together. So like any other fixed exchange rate system, you find some countries are running current account surpluses, other countries are running current account deficits. And in the euro area, we find that certain countries, Italy, Spain, Portugal, Greece, and even France, if you look at their balance of payments from 2005 onward, are running persistent deficits. A lot of this is because of underlying structural reasons. Structural reasons, right? Their costs of production are too high, their regulations are too complex and raises the cost of production. They become less competitive vis-a-vis their trading partners. What does that mean? Can we solve those problems by flooding the banking system with ECB liquidity? Not in my lifetime, right? The whole idea of ECB liquidity is to buy time so that you can put in place these structural reforms. And there again, you and your investment decisions have got to decide, are they making use of the time that the ECB is providing them well? Are they using the time well? Are they frittering it away? That's the hard question to answer, and that, as an economist, I don't have a clear sense of. And as a former IMF official who has dealt with negotiating with a lot of governments, that's a tough nut to crack. Because if you get promises and you set out an agenda, an IMF program, what guarantees do you have that they will, in fact, fulfill that program? You don't. And that's why we have monthly visits, we have quarterly visits. You know, when you're on a program country, you don't ever stay in this country. You come back, write a report, and go back again. And that's why monitoring, on-the-ground monitoring, is absolutely vital to keep track of what's going on. So that going back to the criteria of an optimal currency area, when the euro area was formed, everyone knew it didn't satisfy the criteria of an optimal currency area. Everyone knew it was missing one key ingredient, a fiscal transfer mechanism. As I said, you have deficit countries, surplus countries. Deficits are financed with a capital transfer. Here in the United States, we have a tax and expenditure system that allows us to tax areas that are growing rapidly and try to subsidize those areas that are growing slowly. And how does that work? It works until those slow growth areas, those deficit areas, manage to fix themselves and become less of a deficit area. People leave, right? They go find jobs in other parts of the country. Wages go down. Industry has to come in, right? You have to restructure yourself in a way to become much more attractive. That's what the euro area is trying to put in place today. All of this talk about a fiscal compact, that is to put some insurance policies in place to try to limit the likelihood of a blow-up in the future. Does nothing to address the blow-ups today. So I think that's something I think you got to keep in mind when you listen to the negotiations. Are they trying to fix the mechanism so that we can work in the future, or are they trying to address today's problems? And so far, all I've heard about addressing today's problems have been flood the banking system with money, prevent the banking system from crashing because that would cause even more of a systemic crisis, and try to put in place those structural reforms that are needed to sustain the euro area. Those ingredients are things that you need to keep track of, right? And not worry about the latest blow-by-blow. So from a strategic point of view, the euro area really is quite a mess. And we know that the politicians in Europe love to delay difficult structural decisions. So they buy time. They buy time with liquidity. They buy time with longer liquidity, three-year repos, and all that kind of stuff. That seems to be the strategy, is delaying things. Now,
Can I interrupt you a second? Do you have a view as to, I don't know, say the euro's in a trading range, whatever it is, the next year, 2, 3, since we have long-term European assets, any view if it blows up outside those ranges, or it's just going to muddle and life goes on? And
depends on what you mean by blow up. How Greece exits the euro area is absolutely critical. Everyone knows that it's unlikely they're going to be able to pay off their debt. So something's got to be done. Bigger haircut and more reforms, right? So that there's some likelihood that whatever they do have to pay can be paid. Since everyone knows that already, it's being priced in. And if everyone knows that the authorities are out to ring fence Europe and prevent that from going elsewhere, they're preserving the euro mechanism. And so with those two ingredients in place, right, that trading range reflects exactly that assessment. It'll vary depending upon day by day how you think the mechanism is holding together, and depending upon whether the structural reforms are more or less credible that day. But the forces at work are these balancing forces.
So I put words in your mouth. It shouldn't come out of a trading range. Plus or minus 20 cents. I don't care what it is, some number.
And let me give you the signals to look for when they do come out of the trading range. Somebody walks away and says, "To hell with this, I'm out of here." Right? You have somebody who just freaks out. You have a discovery that the reforms going on in Spain and Italy have suddenly died. That not only are people in the streets in Athens, but they're coming on the streets in Rome and saying, "Enough of this. The IMF means it's my fault. Forget it." If you have that kind of populist revolt, right, then you start seeing that range being priced. But I think those are the kind of extreme things you have to look for. Right now, as I said, there's a lot of confidence in Lucas and his ability to negotiate with the Greek political constituencies, and there's a lot of faith that everyone knows it's too costly, especially for Germany, for the euro area to break up. Because let's not forget, when the euro area formed, who benefited most from that euro area? The Deutschmark devalued by 20%. So in that sense, right, German manufacturing, the great German manufacturing boom that took place, was sparked by a hell of a relative price shock, right? So when people talk about the German economic miracle, and being the former desk economist for Germany back in 1996, let me tell you, the discussion back then was, what do we do with this basket case? How are we going to prescribe structural reforms to contain wage increases, contain their social expenditures, dynamize the economy? Where's it going to come from? 1998, 20% devaluation helped a hell of a lot. So again, structural reforms are difficult to put in place, and that's why all this discussion is so difficult.
Thanks.
Now, as depressing as all this is, right? Let me
Don't slit your wrist.
let me say,
Totally relaxed.
there really is good news out there, right? So let me ask you to turn to page 21. In the last 2 years or 3 years since actually it's been 2008, so since the financial crisis, what we've seen is a very rapid resurgence in global capital flows. And from that map, the story there is that a lot of these capital flows are going into the emerging markets. Now, I spent a lot of time in this deck talking about what it is that makes capital move. I'm not going to bore you with that. But as an economist, I can't help but to show you one regression. So bear with me. Page 22. A lot of your consultants who are in the room, a lot of economists you hire, a lot of people will tell you, I can explain capital flows and I can tell you how it is to find good locations. Let me show you what typical regressions are for capital flows into the emerging markets. There's a lot of blah-de-blah here. Focus on the R squared. The message here is that we can only explain about half of global capital flows across countries and over time. And of the capital flows we can explain, most of it is direct investment, which is that the second column there, direct investment flows, right? Look at the R squared. And what we cannot explain are equity flows and portfolio bond flows. Bank flows are not too shabby. We can explain about half of those. So the message here is, I can find you a lot of significant factors that affect capital flows. Look at the standard errors and t-statistics on each of these coefficients. They're beautiful, right? I can publish them. This stuff is published, and this was written by my former IMF colleagues, which is why I believe it's an honest regression, because we filter our stuff tremendously to make sure it is honest. But the story is, we don't know what we don't know. We don't know what moves equity. We don't know what moves fixed income flows. And that's what worries government officials. That's why you hear stories about putting in place capital controls. That's why they worry that suddenly the stuff comes in, floods their financial system, overwhelms everything, causes asset price bubbles if they're not ready for it, and suddenly it blows out because it finds something else. Hot money. It's not volatility. It's what we don't know, what we can't explain. So that's my sort of academic message to you, which is be careful of people bearing good regressions. And let me tell you, I can trick these regressions and give you R scores of 0.9, but it doesn't mean I can explain anything. So there are statistical tricks and there's real knowledge. What I'm telling you is that from a professional perspective, we don't know what we don't know. But let me take a more strategic view of how it is to find growth opportunities in global economy. On page 23, this summarizes the sweat of a lot of dissertations and a lot of research in the academic world. And essentially what it tells you in that green box is that these are the preconditions that have to be in place for sustained growth. You've got to have a skilled workforce wherever you're going. You've got to have adequate infrastructure in place that complements the private sector investment that comes in. You've got to have economies that are open to trade and financial flows. You've got to have a positive business climate. You've got to have supportive macro policies and an adequate legal regulatory framework. And this is really more important than anything else. Frameworks that allow sufficient transparency so that you, the outside investor, can get a view of what's going on in the corporate world there and in the financial world. You have to have a rule of law so that you can write contracts. You got to have a way of enforcing these contracts. You got to have an independent judiciary to be able to adjudicate any kind of breach of contract. But what's absolutely critical is that you've got to have a well-developed financial system that's able to sort through the money that comes in and allocate it to its best use. And how do you do that? How do you ensure that we have sufficient degree of financial development? If you flip the page, the latest research shows you that, in fact, you can identify key thresholds in the level of financial development in a lot of economies. And what does it mean? Let me quickly flash to the answer, which is on page 26. Here's an example of an indicator of financial development. It's called financial depth, the degree to which credit is used to produce GDP. That 45-degree line means that those economies that are above the 45-degree line have actually increased their financial depth. But those economies that increase financial depth above the 45-degree line, above the critical thresholds, are Singapore, South Africa, Korea, Thailand, familiar growth areas, right? What about the economies that increase financial depth but are still within the box? Countries like Turkey, Philippines, Indonesia, Argentina. These are economies that have moments of growth. They have moments of glory in the sun, but it always peters out. There's something that always screws up, and somehow they fall back into this low-level growth equilibrium trap. So on the next page, I sort of sort through the list of countries and show you a ranking of growth opportunities and financial depth. So these analytic tools, I think, are very useful to try to identify what it is that you're going into and to be able to sort through what may be otherwise very attractive opportunities and to try to ask yourself and answer the question, am I going into areas that will sustain growth, sustain profitability, sustain productivity long enough for me to recoup my investments, especially from a long horizon perspective. Now, let me return to a much more strategic view of this global flow and these growth opportunities. On page 29, this is the heart of the good news that I'm bringing to you. Emerging market economies like China, South Korea, India, Brazil, they're beginning to flex their economic muscles. And what does that mean? They're forging new linkages. They're linking emerging market economies with other emerging market economies. And we at Citi view these linkages as so important, we're recalibrating, retooling ourselves to try to participate and develop these flows and to try to participate in these flows. And on page 31, I show you how important the face of the global economy is going to be changed. Right now, the largest trade corridors are Western Europe to Western Europe. That accounts for about, intra-European trade accounts for about 25% of global trade today. By the year 2050, we're anticipating that Asia to Asia, both advanced Asia to emerging Asia and among emerging Asian countries, will account for about 28% of global trade volume, while the Western corridor, the old corridor, will whittle down to about 6%. That's how much the trade world is going to change. And on the next page, you see capital flows follow trade. So for us, what does this all mean? These new connections mean that we're going to have to learn to adapt to this very new environment and challenges that are going to be very different from what we've experienced in the advanced economies. We're all going to have to contain our sense of hubris and belief that we know all the answers simply because we're successful in dealing with the large companies in the advanced economies. we're going to have to learn to identify and build alliances with emerging market champions, right? Those companies that have learned to adapt themselves to this environment and have learned to thrive in it. We're going to have to either make alliances with them or they're going to eat us for lunch. So this is, I think, the most important challenge that's facing us today, is to make use of what we know in the advanced economies, but adapted to this new environment. But ultimately, as I said to you before, the fundamentals are what counts. And what are the fundamentals? I summarized them for you right there, right? You got to look for openness, right? You got to look for economies that have market economy. You have to have adequate investment in human and physical capital. You want to have economies with high quality institutions and high quality financial development. And so in the end, as I like to point out on the next page, page 31, we're all on the same journey. And as the center of gravity shifts from the mid-Atlantic toward the east, I'm glad you invited me to at least discuss these developments for you today. So, have I, is that within 20 minutes? I'll gladly accept any questions right now.
No? Diane?
Okay, thank you very much.
Thank you.
Thank you.
Around the world in 30 minutes.
That's what we do at our briefing for the IMF board. It's a whirlwind. So thank you.
All right, thank you.
And please, if you have any questions, don't hesitate to just drop me a line or just give me a phone.
Okay. He's going through all the Maastricht Treaty and Troika package. He's good.
Okay. Everybody have their monthly reporting package? I'm going to skip the economic review since we just spent 30 minutes on the traveling the globe.
Larry, before we do that, the density was very great in the last presentation. You took 3 steps backward. What are the 3 or 4 points that you took away that are most important? Because it was hard to follow. It was very dense.
2 or 3 points, or really 1 point, and it is the, well, you're right, there's 2 or 3. The first is the over-leverage in the world is being dealt with slowly, right? It's like, it's the classic letting air out of a balloon slowly without popping it. It popped in the U.S. in 08, a mess. Now you got the rest of the world, particularly centered in Europe, trying to figure this out. And the European thing isn't a country, so there's no one in charge. So this is just going to be complicated.
And the way we're going to look at it is, what is the percentage of debt as a percentage of GDP in each country? Is that the best way to look at it?
That's the simple headline. It's like a thermometer. So, all right, you already know who has a fever. What do you do? And the what do you do is a mess, because there's 32 countries that have to agree. So something that was, so it's very hard, right? That's number. So the first takeaway is very hard, and very hard in economic terms now is called muddle. So we're going to muddle for a couple of years. In Europe, the first guy with a flat tire was Greece. Don't know what the hell to do. Everyone's trying to figure it out. There's a whole bunch of cars with flat tires coming. That's muddle number 1. Takeaway number 1 is this does not get fixed over a weekend. It's not AIG. It's not this. It's not a U.S. thing. It's the European slow muddle. At the same time, you have another part of the world, the emerging markets, which are doing pretty well, all things considered, because you can't turn the clock back. And if you look out 10, 20, 30 years, they're going to become, China in particular, the world's biggest economy. So you have the short-term problem of you've got what's sort of the 3rd biggest economy, which is the euro, stuck in muddle. You have the U.S., which is coming out, but has its own debt problems like mortgages and high unemployment. But you've got this other big thing over here, which is kind of, I wouldn't say looking at it and not worrying, but it's going from 10.5%, 11% growth to 7.5%, 8%. Still pretty goddamn good. Since Europe is going to be negative for a year or two. So how you play all that and make money today is complicated. And taking the euro and trying to figure out how that gets fixed, there's no good answer. So my purpose in asking about the trading range is a lot of talk, but you can't get lost in the talk. We're long-term investors. So long-term investors are supposed to say, some of this is opportunity. So if you look at our asset allocation, we're going up in emerging markets, equities, because that's just a good thing long-term to do. Interest rates are being held down by the Fed and European monetary authorities. Okay? If interest rates are going to be held down, we should be trying to find things that have higher interest rates, high-yield bonds, opportunistic fixed income, all consistent with the strategy. Not to say you want to have things blow up along the way, but if you're a longer-term investor, don't get crazy about the ups and downs. Now, we worried, for instance, a while ago about catastrophe, because there are catastrophes along this way that can happen and spin out of control. Trying not to get too fixated on that, but that was sort of last fall, August, September, to be notable. But other than that, just kind of keep your eye on the horizon. But there's an awful lot of stuff that can go wrong that I would tell you are opportunities. The droning on of 1 billion people joining the economy, the global economy, is a big deal, and you can't go back. And you envelope that in the internet and everything happening quicker with productivity gains. The answer is this isn't good. This is going nowhere but up, but it's going to be slower than you're used to because of the debt. The debt has to be dealt with, and you read about it every day. Greece. I mean, what it basically says, Greece is 2.5% of Europe. So what's the big deal? The big deal is they're grossly overextended, and you have to figure out, basically, it's defaulted. Well, what do you do with that? Well, I don't know, because they're kind of stuck in this euro thing. So people are making up the rules as they go along. It's very complicated. But, again, the beauty of long-term investing is you get to actually take advantage of it, get your cards right.
Yes, speak up, downhill, Harry.
Sorry. You need to get...
We got the rock concert outside going.
You need to get the cards right and just sort of a little bit of stay the course or make little changes here and there, but I would almost tell you take advantage of it. So, I mean, again, we're going to go through this monthly. It bounces around monthly, but I think what we'll find is there'll be some potholes in this road, but ultimately this is going up. In the emerging markets, it's doing nothing but going up, and we don't have enough exposure to it. So we got to figure out how to make money there and make money on the deleveraging of the U.S. and Europe.
Okay, thank you.
Sure. So if you go to page 18 or 19, this is the dollar. And again, big depreciation of the dollar, then it started to bounce around again because of the euro and other currencies. So what's happened in periods of strife, the dollar goes up. So that's what this is. The dollar going up is a flight to safety. If you go to the next page, you see the problem of the U.S. dollar versus the euro, both of which are being enormously manipulated by the government agencies that are in charge of this, the Fed and the EM. Next page is rates below. The good news is here on page 22 is sort of what you were asking. Periods of anxiety, ultimately, you get over the anxiety, you go back to business as usual. So I would tell you VIX below 20 is people are calm again. Not to say it won't become uncalm shortly again, but if you take a leap of faith with me that things are calm, and then go to page 23, 23, the key line to focus on is the white line. It's the U.S. Treasury curve. It's the Fed continuing to tell everybody, hey, we're keeping rates down. And since our last board meeting, I think the Fed said, hey, we told you it's through middle of 2013. Let's make the middle of 2014. So nothing to do but keep rates down, and we want you guys to take some risk because you're not going to get paid by being in my securities or treasuries. So hence, look at the next page, 24, 2% for 10 years. It's not a very attractive rate. On the other hand, prices are going up. is the opposite of yield. So we have a lot of treasuries who made a lot of money in bonds. You go to page 25. Again, this is kind of like the opposite of the VIX. Spreads widen when things get anxious. So you may recall we sold a lot of high-yield bonds. Now we're buying high-yield bonds as a spread. Again, listening to the Fed, we're going to keep rates down. Spreads have to come back down. It's a good time to buy high-yield bonds and then ride it down. You go to the next page, 26. Earnings are going up, which is the blue line. Stock prices for the last 2 or 3 weeks hadn't gone up very much, so multiples are coming down. If you look on 28, to your point again, these are the PE multiples of the top one is the U.S., the Russell 3000, then IFA, and then EM. On a historic basis, these are cheap stocks. So the question is, and what we've been slowly doing, is moving more into equities to take advantage and get our positions for ultimately when stocks go up. Same thing on page 29. And what you see on page 30, again, since we last met, the European Central Bank said, enough of this muddling. We're going to help bail out the European banks. We're going to make 3-year loans to anybody who comes. End of game. Stop worrying about these banks for a while. So that basically said the banks going bust in Europe is off the table because we said so. So instead of being funded by the markets, we'll fund them. So once you calm that down and you stop worrying about the banks temporarily because the lender of last resort was going to be the countries, which are over-levered, everyone says, stock markets then go up. So that's what this is. In the last 4 weeks, stocks are up 5-6%. Again, they're not going to go up 5-6% forever, and they probably go up too fast, but up. Generally up as long as you take some of the risk off the table, which is what happened. So if you look on 32, this is the monthly chart of how the police pension fund's gone. It's sort of in October, November, December, when things were sort of bouncing around a little bit, and we'll show you a little more detail, sort of hung around 23-ish, 23 and a half. If I look to the end of January, we'll have a very nice meeting. We're north of $24.5 billion again because the stock market's up. Stock market's up, bond market's also up because the Fed's keeping rates down. So we're going to have a very good meeting next month. And you should all come. Skipping to the next page. Now, if you go over 34, recall that a lot of things happened after we did our asset allocation. So we were going from this asset allocation on 34 to the one on 35. The key takeaways here on 35 are we like U.S. stocks within the range. We're okay with IFA. We're a little underweighted emerging market equities, which we're working on because we've just finished an RFP for some new managers as well as existing managers. We're underallocated hedge funds because we're working on the program. Then you look all the way over on the right, you'll see the cash number because we decided to de-risk things coming out of the summer. It was high as 8.5%, 9%, it's 4.7%. Some things that we've done, we've added 1% to high yield, we've added another 0.25% to hedge funds. So now it's probably about 3.5% cash. And we're going to continue with the hedge fund program as we talked about. We're going to fund some opportunistic fixed income as well as emerging market equities, and the cash will ultimately go away. The only thing that I would tell you is slower than planned is the opportunistic fixed income investments, and that's just us negotiating with the managers. If you look at page 37, the far left-hand column, and you run your eyes down it, not a lot of action in December. It's really much more action in January. We don't have those numbers quite yet. But if you see on page 38, we made about a third of a point in December. Brings our fiscal year date to about down a little less than 5. I think we made about 5% last month. So we're basically flat. And if nothing happens, I think the markets should generally gravitate up for the rest of the year. So I think we'll start making some money and see where we're at on June 30th. But again, we've taken this opportunity to reposition a portfolio as per the asset allocation and our redeploying the cash into areas consistent with the new asset allocation. The rest is just the manager-by-manager summary, which if anyone has any questions of the managers, happy to talk about. But again, we're down about a little less than 5. We made about 5 last month, so we're pretty much close to even, which I would tell you is okay, given all the volatility that we had in the fall. So it's probably positioned for the next. We're positioning for the next leg of the markets. Any questions? Perfect. Then we're done with the. We have no more business for the public session, unless anyone has anything else they want to talk about.
Motion to leave executive session, public session, and go into executive session.
Second, SBA. Okay.
Okay, thank you.
Thank you.
Take a 5-minute break just to have them break down the cameras and